Hi, thank you, and welcome everyone. The National Caucus and Center on Black Aging, Incorporated, and Women's Institute for Secure Retirement, WISER, welcome you to our webinar on ways to prepare and save for retirement. Our presenter, Dr. Laurel Beaton of WISER, spent her career working on retirement income policy as a researcher, writer, speaker, and educator in academia. She continues her policy work part-time. Excuse me. Our presenter, Dr. Laurel Beaton of WISER, spent her career working on retirement income policy as a researcher, writer, speaker, and educator in academia, government, think tanks, and on Capitol Hill. In retirement, she continues her policy work part-time and is a member of the English Department Alumni Advisory Board at Virginia Tech, where she received her doctorate. Laurel, welcome and thank you so very much. We appreciate you.
Good afternoon, everybody, and I'm delighted to be here to talk with you about something that is incredibly important to all of us, no matter how old you are. Even if you're in your 20s and say, hey, I'm not retiring for a good long time, or I'm not going to be able to retire until I die, or people who are getting ready to retire, there are things that we all need to think about. So let's jump in. Let me tell you a little bit about who we are and then both feet. Next slide, please. WISER is very quickly, we're a nonprofit and we work at providing women with basic tools and financial information aimed at helping you take financial control of your life. Wiserwomen.org, look it up. It's really a good thing. Next slide, please. The National Resource Center on Women in Retirement is a website that we operate with the Administration on Aging, and it is a one-stop hub, one-stop gateway to provide basic retirement information. Next slide, please. And this is our new and biggie, the WISER Financial Caregiving Hub. And as I think it was Rosalind Carter who said, if you aren't a caregiver yet, you're going to be one, or you are one, or you have been one, or you're going to be the receiver. Caregiving is so important these days as an issue in finance. So WISER has a caregiving hub. I recommend you take a look at it if you are any of those four. And we are not the cool answer, but we provide references, places you can go to get the cool answer. Next slide, please. What we'll cover today. The big picture of retirement, the individual picture, financial to-dos, and I've broken it out into decades, age groups, sources of retirement income, the basics, and then more stuff you need to know. And if we have time, I can go over the resources and tools, but if we don't, they will be there on the slides for you to take a look at. Next slide, please. The retirement picture, big picture. 2/5 of the baby boomers nearing retirement have no retirement savings. Now, baby boom, and I'm a member of the baby boom, we were born 1946 to 1964, a big lump of us born starting after World War II. We are age 60 to 78, approximately. And imagine 2/5 of us have no retirement savings. That basically means 2/5 of us are going to depend on Social Security. Keep that in the back of your mind as we move through. 45 million workers are without access to retirement plans at the workplace. Now, I looked up the number to make sure I had an up-to-date. The civilian labor force is 167 million. give or take. 45 million workers. There is no retirement plan for them to participate in their workplace. Again, what that means is 45 million workers today need to create their own savings plan, and that Social Security will be there for them, but not an employer provided retirement plan. 24 million workers have access. That means that it is available for them, but they do not participate. One of the big reasons people say, I can't be in that plan, is I can't afford it, or the rules don't quite apply to me. I don't have quite enough hours in to be able to participate as an employee of the company. Interesting little fact, 19 states have started retirement plans for small employers, that their workers are able to participate in a plan. And the biggie, and keep this in the back of your mind, Social Security is the foundation of retirement income for most of us. And some changes are needed to keep paying benefits in full and on time as of 2034, but that doesn't mean Social Security won't be there. It does not mean that Social Security is broke. And I'll talk quickly about that in a little bit. Okay, next slide, please. That was the overall picture. Now the individual retirement risks and other shocks. And I noticed when I made up the slide, I put my picture of our woman with the world on her stomach. I cut out a word, so I'll tell you what that is. First of all, individual retirement risks and shocks. Unexpected job loss. I imagine if you haven't lost a job, you will at some time. Your company can go bust. COVID happened, people lost their jobs. It happens, additional caregiving demands. If your spouse or your mother or your child needs extra care, you may have to pull out of the labor force or work part-time. Investment losses. You make a bad investment. Your nephew says, if I ever got a stock for you and you want to support your nephew, so you invest and you lose that money. Another thing that happens, because we are living longer now than people used to, outliving your money. And that comes back in. Let me give another little notice for Social Security. Social Security doesn't go away until you go away. Loss of benefits, loss of spouse, or loss of job. In other words, I've always, loss is an odd word for me when we say loss of a person, because it could mean they died. It could mean they divorced you. It could mean you went to the park together and they wandered off and you lost them. But loss of spouse, as far as benefits mean, if you depend on your spouse for contributing to a joint and survivor portion of a pension, or maybe healthcare benefits, or loss of job. If you lose your job, that's what's missing there. You lose your, if there were retirement benefits or healthcare benefits, you lose those benefits. Financial problems of adult children or other family members. If your child, maybe your son is divorced and has 2 children that he is responsible for, or your daughter's spouse dies, that child may come to live with you with the adult children. Not quite yet. Can we go back? There we go. One more forward, please. There we go. Your adult children or other family members that may need some support from you. And the last is chronic illness and higher healthcare and medical expenses. That can, one big medical expense or illness can destroy your savings. And of course, we all know about inflation. Now, next slide, please. So let's get into some specifics. financial to-dos for the decades. And if you are in your 50s, tell these things to your children or your young friends who are in their 20s and 30s. And we'll talk about this as we move forward. If you're in your 20s, check out your job benefits. Make sure you're taking advantage of all of the benefits that your employer may or may not provide you. If they have a savings plan like a 401k or a 403b, be sure and participate in it. Get into the habit of saving through your employer, but also if you can, save for yourself. If you get a raise, put that to the side, save it. Start retirement saving. Designate, this goes into my retirement savings account. This is my emergency account. We'll talk about that in a minute. Strive for a debt-free life. Now, I know everybody rolls their eyes and says, oh, I can't be debt-free. I have student loans, I have a mortgage, I have a car payment. Yeah, you do. And those things you need to have, but also think about not using your credit cards all the time for something you want as opposed to something you really need. Now, as you move into your 30s, keep saving and focus on investing. Are there ways that you can make your money grow? Things that you can do with your money? Keep your debt in control. Do an insurance checkup. Do you need different kinds of insurance? Do you need term life insurance in case something, if you're the breadwinner in the family, if something happens to you, should you have term life insurance? Is your car insurance up to date? And I know the state of Virginia requires that you have some kind of insurance. This is new. Not everybody has to have insurance. And pay attention, once again, to your job benefits. A lot of times people aren't taking advantage of the things that their employer provides for them. Next slide, please. Your 40s and 50s. In your 40s, now start thinking about retirement projections and set a specific goal. When do I want to retire? Can I retire? Do I need X number of dollars to achieve what I want to achieve when I retire? Increase your retirement account contributions if you can to your personal individual retirement account or your savings that your employer provides. Before 49, try to be saving at least, hold your breath, 15% or more of your salary plus your health savings accounts, if you have those. And you may want to consult a financial professional, and sometimes financial professionals are expensive. If you're interested in a financial professional, and again, we have those references on our website, we have a number of fact sheets on how to find a financial professional, how to find a legitimate, I mean, you can call yourself a financial professional, but not have the certifications. So you may want to do that. If not, go to professional sites, and I've got lots of references in the back with the reference sites. Now, age 50. This is when you start upgrading your skills as needed for employment because you don't want to lose your job in your 50s. Are there things that you can do? I love my job. I want to stay doing my job, but what can I do to make my job the way I do it better? I learned some of the new statistical programs when I was in my 50s. Just about killed me, I have to say, but it helped me keep up with what I needed to do. Take advantage of the higher individual retirement account and 401k account limits. Generally, you are limited to how much you can contribute to your individual savings through your employer or individually. When you turn 50, there's something called a catch-up, and that increases the amount that you can contribute. That's really a bonus. And if you can do it, even if you can't contribute the whole amount of the catch-up, contribute as much as you can, because when you're 65 or 70 or 75, working and saving is going to be much, much harder. Do it now if you can. Compare your savings amount to your goals. When do I want to retire? What do I want to do when I'm retired? If I want to live on a yacht in Tahiti, it's going to be more expensive than if I want to live in the grandma apartment in my daughter's home. So think of those things. Get your documents in order, and we're going to talk about that, and check your beneficiary designations. Something I like to talk about with people when I say this, say, oh, well, it'll just go where it goes, the money, or my husband will get it, or my daughter will get it. Do you have, oh, I know this. Can you see? You can sort of see. This is my mother's wedding ring, or her engagement ring. And it came to me because my mother designated it to come to me. And I am proud to have it. And not that I wouldn't have been proud to have my sister-in-law get it, but there's something special about it coming to me. And so it was written down that I would get my mother's ring. If you have some special things, be sure you have your things with beneficiary designation. Now, that also counts for your IRAs and your 401ks and your joint and survivor portion of pensions. It's very important that if you don't want your spouse or your relative, your first relative, depending on how your state calculates who gets things automatically, you need to specify that. So it's important not just for your wedding rings, but also for your pension and your 401k, that money you've worked so hard to save. Okay, into yours. Oh, and last thing, by age 59, start thinking about the best time for you to claim your Social Security benefits. Next slide, please. 60s and 70s. Into your 60s, now you're starting to hit the ground. Review your retirement accounts and your distribution requirements. At 59 and a half, you can start taking money out of some of your savings, your 401ks and your IRAs. Think about that. How much is required? They're called required minimum distributions. Some of the accounts before 59 and a half, if you take your money out, you have to pay tax and a 10% penalty. After 59 and a half, you can take your money out, but you have to, for IRAs, depending on your age, you have to take a certain amount out. I just made that not clear, didn't I? We'll try again as we move through about taking money out after age 59 and a half. Hold that thought and I'll come back to it. Think about your retirement age and your optimal Social Security claiming age. You can claim Social Security anytime after you turn 62. But at 62, because you've only been paying into it until you're 62, your benefit is going to be lower than if you wait until your full retirement age and or up to age 70. Because you contribute to the system longer, you get a higher benefit. And I have a slide, I'll break that out for you. Think about when you want to retire, if you can afford to retire by putting everything together and adjust your Social Security claiming age to that. And then you want to analyze your spending. How am I going to spend the money that I have in retirement? Do I have enough? Consider part-time options. A lot of people, they will retire at, say, 63 or 64, particularly if they're in a physically demanding job, and then go maybe part-time to continue to come in underneath and supplement their income. The other thing is you want to review your Medicare options and your choices. At age 65, you need to apply for Medicare. It doesn't come to you automatically. You need to apply. Part A is for hospital. Part B is for doctors and all of the other things that come along with it. But Medicare doesn't pay 100% of everything all the time. So be aware of that and think about that, and then create an estate plan. And this, we'll talk about the documents in a minute. Age 70, start your withdrawals from traditional IRAs by age 72. Now, that has just changed, and it's called required minimum distributions. And the point of the IRA was for you to save so that you could put money out when you were retired and you aren't earning anymore. However, some people wanted to leave, they had enough money and they wanted to leave their money in the IRA so they could earn more money on it and not have to pay taxes. And what has happened is they have moved the year up for when you have to take a percentage of that money out to spend on your retirement. And of course, if you have a regular IRA, pay taxes on it. And start your Social Security benefits at age 70. If you delayed receiving them, you get a benefit from full retirement age up to age 70 of almost 8% a year increase in your benefit. So if you can, it benefits you to do that. If you can't, you earned it, take it when you need it, but understand what the reductions are. Okay, next slide, please. The sources of retirement income, and this is the big three: Social Security, employer-sponsored plans, and personal savings. Okay, next slide, please. Let's go to the biggie. Social Security, it is your base of retirement income. We all pay, and our employers pay 6.2% of the earnings that you have up to $168,600. That's this year. It increases every year. The minimum number of credits to qualify for retire worker benefits is 40 credits. That's you can earn 4 credits in a year, and so that's about 10 years worth of contributing to Social Security to get a minimum benefit. Now, this is a fire hose of Social Security, but keep these facts in mind. Your benefits calculated based on your highest 35 years of earnings and contributing that 6.2. If you are self-employed, you pay both 6.2 and 6.2. But that 35 years, if you have not contributed for 35 years, zeros are calculated into the 35-year average, so that lowers your benefit. So if you can, even if you're working part-time, contribute so you can fill in that 35 years. If you work more than 35 years, it's the highest 35 years. And your benefit is calculated based on a wage indexed average over that 35 years. It's not like pension plans, the defined benefits, they're usually based on a high 3 or a high 5. Social Security represents your whole working lifetime that you contributed to the economy as a worker. Okay, next slide, please. this is a biggie. Please do this. Unless you're already retired and getting these. Create a My Social Security account and keep track of your benefits. You just go to ssa.gov My Account, and it will click up and you can sign up. What it does for you is it gives you retirement benefit estimates. It will come and say, we think based on what you're earning today, and if we just straight line that earning until retirement age 62, full retirement age, and age 70, here's what your benefit would be. It also estimates what a spousal benefit would be. It would also get proof that you do or do not receive benefits. It checks your application status. If you say, well, I went to the Social Security office and I haven't heard from them for 3 days, well, they'll tell you what things are happening and where things are, and you can get your Social Security statement. And what the statement does is it gives a record of all of your contributions from your working years. So if you see a blank where, well, I worked for such and such an employer and it's not listed there, then you need to make sure that that employer has contributed. Go back to that employer and say, you should have recorded with Social Security and contributed your 6.2%. as well as mine. So this is available to everyone 18 and older. It is really a wonderful tool. Okay, next slide, please. And employer-sponsored plans. And the next slide, please. Retirement plans from work. Now, defined benefit plans are what we call the traditional pension plans. They are when you go to work. Oh, I know the federal government has a traditional plan. The government contributes and it earns based on my age, my level of earnings, and my years of service. And I get a monthly annuity when I retire based on that. Now, the difference between this kind of plan and a defined contribution plan is that the employer assumes the risk. If something happens to the investments that are made to build up this retirement plan for all the retirees, the employer takes the risk. Now, as we step down to a defined contribution plan, and the names of these plans define them. Defined benefit says you are going to get from your employer a benefit based on this formula. Not going to change. A defined contribution says if you contribute X number of dollars, and there are limits, but again, I recommend you contribute as much as you can to these plans, you are assuming the risk. You will choose investments, and the amount in your 401k or your thrift savings plan or your state facilitated IRA, that may fluctuate due to how your investments fluctuate. The employer is not responsible for that. The employer may provide the administrative work while you are with that employer. And here's the goodie. Employers may match some portion of your contribution. Generally, it is up to 5%. Seems like the average match is about 3%. Do that. I can't emphasize, if you can get your contribution up, get it up there so that your employer matches that with 3% or 5% or even 1%. It's free money to you. Be sure you take advantage of that. It's a goodie. Okay, next slide, please. And here's something obvious about these plans where you contribute yourself. When you leave a job, you may be able to take that defined contribution plan money with you. Now, if it is above a certain amount, generally above 1,000, maybe a little more, the employer that you left may be willing to keep it in their plan with their investments. If it is under $1,000, generally the employers don't want to deal with it. That's understandable. They will give it to you, or you can decide to take it with you. Whatever you do, within 60 days from the date you receive that distribution, this is really, really important. Roll that money into your new employer's plan, if your new employer has a plan, or into an individual retirement account. Don't spend that money. And this really, it happens to women more because women, we are spending our time caregiving, we're spending our time taking care of children, our mothers, our spouses. So a lot of times we aren't working full time, and the money that we contribute is not as much. And so if we leave a job, we say, well, it's only $700. I'll take it, and maybe we can spend an extra few days on our vacation. Please don't do that. Invest that and watch that money grow. Compound interest is the biggie these days. They call it the miracle of compound interest. It means that the earned interest amount is added back into the principal. So if you invest $100, well, I use the example here. If you invest $1,000 at 4% compounded annually and leave it for 10 years, you just earned $480 for doing nothing. Such a deal. Please don't waste that opportunity. I know it's tempting to take those extra few days on your vacation, but it's not as easy when you're 75 or 85. Next slide, please. Decisions to make and mistakes to avoid. In both defined contribution and defined benefit plans, take advantage of any retirement calculators and education sessions that are available. Most larger employers will provide education sessions about the kinds of plans that they're providing. And if they aren't providing plans, they can probably suggest calculators that help you think about how much money do I need to achieve my goal of retiring or buying a business or whatever it is you want to do. And I've got a lot of retirement calculator suggestions at the back of the presentation. Make your beneficiary elections carefully. We've talked about that. In general, your spouse will be your beneficiary unless your spouse consents to naming a different beneficiary. Keep those elections up to date. Excuse me, I need to take a drink of water. It doesn't help if the person that you wanted to leave something to, your 401k or your IRA, if that person is deceased, or if your nephew married a millionaire, probably not the best way to leave that benefit. Also, know your plan's vesting schedule. Is it immediate? Is it X number of years after service? What this means is, are you eligible to receive the benefits that your employer provides? Have you worked there long enough? When Weiser was working with nurses, we found, and nurses are just not, nurses like teachers are not paid very much, or shall we say, having been a teacher and my oldest best friend is a nurse, not what we're worth. Nurses will change hospitals for a 1 hour increase in pay. And that may be a good thing, but if their current hospital's vesting schedule says they need to have worked at that hospital for, make up a number, 5 years to be eligible to receive the pension, and they leave at 4.5 years to get an hour, $1 an hour increase, it may not be worth it. They're leaving the employer contributions on the table when they leave. So please think about the full implications. And your employer has to talk with you about this, or you have to talk with your employer, or look for a plan description. It is required that your employer have a plan description for you. Understand what your pension plan says, what your savings plan says. And another thing we know, a former colleague of mine has looked up a lot of these. After you leave an employer, if that employer had a pension for you and you left it with that employer, and that's perfectly acceptable, be sure that that employer has your current address, a way to reach you. There are an awful lot of people who have left small amounts of money or big amounts of money, a couple $1,000s on the table with a former employer because the former employer couldn't reach them. So make the decisions carefully and try and avoid the mistakes. In other words, you've got to sit on this information. You got to think about it. It's important to you and your future. Next slide, please. Individual savings opportunities and accounts. This is all on you. Next slide, please. Emergency savings accounts are really a biggie. Emergency savings account is cash that is easily accessible, but only for emergencies. It's not for the prom dress that your daughter really wants but can't afford, and another one would be just as nice. No. This is for an economic crisis. You have an accident and your car is totaled. You have a medical emergency. Your husband has a gallbladder attack and finds out that he needs gallbladder surgery and has to be in the hospital for a week and then at home for 2 more weeks and is not going to be able to work. Your house is hit by a tornado and you lose part of your roof, and your homeowner's insurance says that's an act of God. Those are real emergencies, and an emergency savings account can make all the difference in the world. Now, it is recommended by everybody that you have at least 3 to 6 months worth of living expenses. And I know, so many people say, that's too much. I can't do it. I'm not paying attention. I'm not doing it. Start small, build over time. Watch the miracle of compound interest. It's amazing how money will grow. As you put more in, it grows a little more and a little more and a little more. Set up a pay yourself plan and kind of feed the pig. We see the big photographs of the pink pig. Feed the pig your emergency account. Take that out of your paycheck. Don't look. Do it before you need it, and you'll be really glad you did. It helps you avoid using your credit card or getting a high interest loan, such as payday loans, because interest grows, that it compounds as well, and that's not a pretty sight. I was listening to the radio the other day, and I heard someone who had a student loan years and years ago and had been paying a small amount every month, just paying and paying, but the interest rate was so high that it ended up that she was paying more with all of the interest added in than what the original loan was. Interest can clobber you, so be careful about that and think about it, and continue to contribute to your emergency fund while you are paying down debt. and work on getting rid of your debt. Well, I'm going to talk about 359s in a minute. Next slide, please. And here are the traditional individual retirement accounts, always a goodie. And these were created years and years ago for people who didn't have employer provided ways to save for retirement. And a traditional IRA is a deferred savings account, and tax deferred. What that means is that you don't pay taxes on it now. You can take that if you're under 57, there's that 7,000. This is for 2024. If you're over 50, remember I said there are those catch-ups. You can put in more money, $8,000 a year, and that money comes off of your income right off the top, and so you don't pay taxes on that. Your income is 7,000 less. It doesn't have to be 7,000. That's the max. And then when you retire, the theory is you will have less income when you retire. Then you pay tax on that money as you withdraw it. And you can withdraw your money, any money before 59 and a half, and this is what I talked about before. You'll have to pay a 10% penalty in addition to the regular income tax you'd pay. And the 10% penalty is, I know it's your money, but you got a tax break for contributing to your future retirement savings. So after you reach age 72, you must start making withdrawals. And that rule has now changed. And it is, if you are 72 after December 31st, 2022, you can wait until 73 to begin making withdrawals. And you can open an IRA at any variety of financial institutions. Next slide, please. A lot of people say, okay, oh, I forgot the Roth. I have to tell you this, and then I'll talk to you about how to open an IRA, because everybody says, well, you tell me to do it, but you don't tell me how. A Roth IRA is the flip of the traditional IRA. In other words, I take my $7,000 if I'm under 50, or my 8,000 if I'm over 50, or whatever amount I choose, but I pay, that is included in my income. I pay taxes on it now. And the advantage of that is, all right, I've already paid my taxes on that money. So as we move forward, it's earning interest, it's compounding interest. And when I take the money out, I don't have to pay taxes on it. Such a deal. So if your income, now there are contribution limits, and they're right here. If your income is above 161,000 as a single, or 240,000 for married filing jointly, you can only contribute to a traditional IRA. But the Roth IRA, it depends. How do you want to pay your taxes? How do you want your money to grow? Okay, next slide. How do I open an IRA? You can open an IRA at a bank, a credit union, an online broker, or other financial service providers. Your best bet probably is to open one at a no-load mutual fund. And no-load means that the people who sell you the IRA are not going to take a big commission on it. And I just looked up some of the big ones. I'm not selling any of these providers. I'm just saying this will be familiar to you. Fidelity, Vanguard, T. Rowe Price, those are, you can probably get no-loads, but all you have to do is go on Google, search no-load IRAs. Ask and search mutual fund companies for free information on their IRAs to help you decide which is right for you. Okay, more individual savings. Next slide, please. Health savings accounts. These are ways for you to set aside money for healthcare costs. I did a dumb thing about 2 months ago. It was a Saturday morning. I got up early. It was a miracle. It was, I don't know, something like 6:30 or 7. I stripped and changed the bed. I wrapped a package for a 10-year-old niece in Chicago, all set to go. I had an armful of the sheets to go down to the washing machine. I had the package in my other hand, and I stepped on the corner of the bedspread with my left foot and tripped over the bedspread with my right foot, fell forward, and banged into the door. And I, bam, sat down on the floor, kind of rolled over and said, well, I think everything's in place. And then I said, what is all that black stuff on the floor? Well, the black stuff on the floor was blood. You know how heads bleed. You don't have to be terribly injured to bleed. So that Saturday morning, all of that time saving involved me driving myself to the Doc in the Box, the emergency place in the shopping center, with a washcloth to my bleeding head. It was like the Red Sea parted. People stepped away from me. And they said, you have to have, because of your age, you have to have a head x-ray and make sure I wasn't concussed. You have to go to the hospital. So, okay, so I went to the hospital, the emergency room. I drove myself all of these places. And I got there and they did everything. And they ended up, they said, do you want stitches or glue? And I said, which is faster? And they said, glue. So I said, okay, just glue it up. And they did a scan and x-rays, and I was fine. And I drove home, and about a month later, I got the bills from the hospital. Now I am insured and I have Medicare. So I ended up basically not paying anything, but let me tell you, I about had a coronary when I saw what that cost. Now, what it was, they were being safe, and I had to go to the hospital, and they did scans, but they put glue on my head. And by the way, I had to wait until my hair grew out for them to cut this big glop. And I swear to you, it's crazy glue. It just, so thousands of dollars. And that's what the health savings account, if you have one of those high deductible insurance plans. And I looked up the cost of the high deductibles, which are the annual premium, average annual premium for a high deductible is almost $8,000 a year. So it ain't cheap. What the health savings account allows you to do is, once again, save money in before tax contributions for most federal and state taxes. And if your employer contributes to your HSA, it is excluded from your taxable income, but you have to be a participant in a high deductible health plan. This may be something that works for you, so check it out. Next slide, please. These are, ways to save if you can. Savings bonds. I know people kind of snort about savings bonds, but right now the current iBond savings rate is 5.27. That's through April 2024. That will change in May. You can buy automatically from a tax refund if you have one. The iBond rate is based on inflation. If you buy I-bonds at face value, for example, you pay $50 for a $50 bond, you keep them up to 30 years. And you can cash them out after 5 years without losing interest earned. And you can buy them straight from treasurydirect.gov. Next slide, please. Savers tax credit. I will move quickly here. Savers tax credit is a credit for saving. If you save for your retirement, you should seriously consider taking advantage of this tax credit. It is a non-refundable tax credit. Next slide, please, because it's about the same thing here. There we go. If you do not owe taxes, you won't be eligible. But if you are eligible, the net maximum tax credit is 50% of your contribution to a retirement plan, up to a maximum of $2,000. So if you put $2,000 into a retirement plan, you get a credit on your income tax for $1,000. Not such a bad deal. Next slide, please. Other savings opportunities if you have children, the Workplace 529 college savings plans. And once again, these are after-tax ways to save money for your kids or your grandkids to go to college. And it doesn't just have to be your state plans. You can get them all over. Also, payroll deduction. We've talked about individual IRAs. If you have a workplace IRA, some employers offer them, contribute to that if you can. And for more information, by the way, on the 529s, there is a wiser fact sheet. Next slide, please. This was in front of that was a, but wait, there's more. We don't have to go to that. Let's see. Oh, I'm sorry. Tips and tax tips and savers and incentives. Max out your tax deductible retirement contributions. Use a tax refund to start an emergency fund. Don't spend it. Beware of tax scams that commonly target older adults. I almost got scammed. I got a letter in the mail from the Virginia Department of Taxation. It was a scam. Luckily, I caught it. Learn about the earned income tax credit and the savers tax credit. We've talked about that. Next slide, please. But wait, there's more. Next slide. And these are the easy things, financial steps that can improve your future. Plan early and have short-term goals and then long-term goals. Emergency funds. Be involved. If you are married, if you have children of age that can think about this, talk about financial decisions with your spouse, your partner, your older children. They may want to make we can go on a vacation, or we can buy a new gaming system. Also with a financial advisor, if you choose a financial advisor. Avoid credit card debt and pay your bills that keeps your credit rating good. The less debt you have, the higher your credit, or the more consistent you are in paying your debt, the better your credit rating is, and the cheaper it is to borrow money. I know it seems contradictory. Make the most of job-related benefits. If they're providing an employee contribution savings plan, and your employer is also contributing, oh, get that money. It's free. Choose to save for retirement. I mean, make this a conscious decision. Learn about your Social Security benefits, and remember those potential shocks: death, divorce, caregiving, job loss. Next slide, please. Know yourself. How much money do you have? Do you have money in savings? And please, I know that everybody says there's going to be this great money transfer when the baby boom dies and leaves the money to their children. The flaw here is we're living into our 80s and 90s and spending that money on other things. So I wish you well. I hope you do inherit something, but don't count on it. My mother died at 101. I'm going to live forever. So you'll hear me giving this talk to you when, 10 years from now. Where does your money go? Take a little book, keep track. Do you buy coffee or go out to lunch, or where does it go? Use a monthly worksheet to help you budget. Include savings and investing. Include caregiving related expenses if they're there. There's a worksheet that Wiser has, and update your paperwork. Next slide, please. I'm just going to zoom on through here. Legal documents. These are so important. Please review these documents and consider every one of them. I don't care how young you are. You could be hit by a Metro bus tomorrow. You want to have these documents ready. They are a gift to the people who come after you, who have to make decisions for you. It's better if you can say, I know what my mother wanted. I know my mother wanted me to have her engagement ring. I know my mother wanted my nephew to have a portion of that money. Do this as a gift. Next slide, please. We're almost there. Keep your paperwork organized and your money safe. Organize your financial information for you and or your representative and advisor. And this ties into what we just looked at. Be sure that you have the passwords and for your online accounts, your social media. Be sure to create strong passwords and keep them safe. But if I am the person who is to take care of your finances and I can't get into your accounts, it's a real problem. So organize your financial information, but also have the information about how I get to those things. Keep track, monitor your accounts and balances. And this is a biggie now. There are more and more scams. People are able to get in. I know GAO, I'm a former GAO person, and we just got something from GAO saying that GAO's accounts have been hacked and they have all of our information. Now they immediately put down all kinds of tracking information so we can keep track. But it's important that you do and review your credit report. That will tell you if someone has been messing with your credit accounts. Okay, next slide. Never too soon to prepare for your future. Get the information you need, attend classes, check with your employer, talk with a financial advisor or planner. Think about what makes sense to you. Are you willing to live a little bit below your means now to live well later? What are the trade-offs you're willing to make? Will you need to adjust how you're living now? Driving that fancy car, you may want to trade that off for, let me see, I drive, this is unusual, I understand, but I drive a Corolla, a 2012 Corolla, but it starts, it gets me where I need to go, and it's paid for. So think about those trade-offs. Next slide, please. Know what your retirement will cost you and are you on track? And you want to figure out, again, I say it again, how much will you need in retirement? And there are lots of tools and online calculators to help you figure it out. There is no cool answer or number for how much you need, but think about it. And here are some examples, Transamerica, T. Rowe, next slide, please. Don't be afraid to ask for help. There are no dumb questions. Come to wiserwomen.org. Problem with your credit, National Foundation for Credit Counseling. The FTC has information. Another source I forgot to put up here is the CFPB, the Consumer Financial Protection Board. Consumer Financial Protection Board. It is a wonderful source for all kinds of financial information. Next slide. Retirement investment calculator. Here are literal calculators. Again, Wiser is not being paid to promote any of these resources. It's just that we have found them to be relatively easy to use and have good information. And next slide. That's my thank you. And please, here's the Wiser Women website. And I know I talked fast, I fire hosed you with information. The slides are available for you to use the information. That's it.
Laurel, excellent, excellent, excellent as always. And we are at 2:01, but I want to just ask you if I can just get one question in and ask our audience to bear with us for just a few minutes.
Sure.
So here's a question. Can I ask you to define for our audience, when we speak to financial planning for our future, what are wants versus needs?
Okay, and I think that baseline needs are the obvious: food, housing, transportation, and it doesn't have to be. And here's where your wants come in. Can you do with a 1-bedroom apartment as opposed to a 2-bedroom or a 3-bedroom apartment? When I'm looking at downsizing now, and it's killing me. And I'm trying to think, well, you know, a 1-bedroom is much cheaper. Okay, right? I need transportation and I'm still driving, but I don't need to drive a Lexus. And you know, my little 2012 Corolla is fine. I need transportation. Something I'm looking at as I'm on the board of Senior Services Alexandria. We provide Meals on Wheels in Alexandria and a lot of other services. And I have been looking at a lot of the continuing care retirement communities that have independent living, and they have nursing home, and they have assisted living. And I look at some of them that are way outside the Beltway, and there are some that are way inside the Beltway. And I need a nice place to live, right? However I define that. And I want to be inside the Beltway because I do a lot of stuff downtown. And I live very close. I live just below the Pentagon now. So to me, is that a want or a need? I'm not sure. Um, and you can look at food. I went out to lunch. I had a birthday last week, and I went out to lunch with a friend, and I could not believe restaurant. Ooh, is that ever expensive? A want. It was a lovely, lovely lunch. I need to eat. I don't need to eat at a fancy restaurant. I can think carefully about what I buy, and I can have a plan for my week's menus and buy food so that it is sensibly purchased and I'm not throwing out food. And again, that's a good, we were talking about Earth Day was yesterday, and not throwing out food. So I think needs and wants, it is thoughtfulness. It is having a goal and being thoughtful about what I need and what I want. And I think you as individuals can think about that. And something I do want to say is you do need to, it's really important. We want to put our children through college. We want to quit our jobs to take care of our mothers. But the thing we need to remember as well is if I take money out of my retirement account to send my child through college, my child can probably get a job whether my child goes to Virginia Tech or Harvard. At age 80, I probably can't. And I need that retirement income. I think that's important. My mother, I want to quit my job to take care of my mother, but that may mean I lose my health insurance. I lose my contributions to Social Security for those years I'm out of the labor force, and I lose contributing to a savings plan when I'm out of the labor force. So I need to think about, is there a way I can compromise? Maybe talk to my employer and say, how can I keep my health insurance? How many hours do I have to work? I want to take care of my mother, and maybe negotiate with my brother about how we can split the care. So there are needs and wants. I need to take care of my mother. I want to take care of my mother, but remember, you're going to be 70 or 75 or 80 as well, which is why what you just heard today is so important.
Perfect segue. I want to thank you, Laurel, for always coming and delivering just a stellar presentation to NCPA. You're welcome to come back anytime. It sounds like we've got a lot to
Thank you.
talk about on your next visit. So again, thank you and thank you so much for joining us, and to our audience, thank you for hanging in there. And if anybody would love this presentation, we will get it to you. Just shoot us an email and we'll get it to you today. Thank you again, everyone, and have a good afternoon.
Always a pleasure.
Always a
Thanks.
pleasure. Thank you. Have a good day.
You too.
Bye-bye.